This is Mark from Right Line Trading, and I just wanted to read this quick disclaimer that Right Line Trading takes no responsibility for any participation by visitors, subscribers, for any profits or losses that may be incurred. That careful consideration of your financial position should be made prior to trading. Never risk more than 2% of your account on any trade. Do your own due diligence. Consult a financial advisor prior to making any trading decisions. We are not registered financial advisors and not licensed commodity trading advisors. So with that said, a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia, and I published close to 15 peer-reviewed articles in first-tier journals. You can find them on Google, some of them. And I've been involved in the financial markets for over 20 years. And what we do at Right Line Trading is mathematical modeling. We look upon the movement of any financial instrument as movement in a closed system. A closed system can, the way a closed system works or moves can always be described by a series of independent variables that, when placed in a multivariable equation, is going to really predict, as I said, how that system behaves. So what we do is we describe price action, market structure, and indicator algorithms by defining certain dependent variables, and I'm going to show you all how that works. You are one of the fastest growing trading systems on Ninja. Now our market profile 2.0 is really a method of how to find very low risk, high reward trading entries on the futures, forex, and stock markets. It works on any financial instrument and on any time frame. In fact, if any indicator system, if any set of trading rules was not time independent and did not work on any financial instrument, then it really doesn't work. The rules that it uses, the forces that come to bear on price in any financial market are universal, and the systems have to work in any market. Now, this really leverages volume, and volume generates areas of support and resistance that are really critical to examine, and it also gives you an absolute direction to which you must trade. So these aren't secrets. But first of all, there are volume zones which are dynamic, and they're constantly undergoing adjustment, and they're recalculating intra-candle. And there's no formal zone of support or resistance. When resistance breaks, it becomes support. And when support breaks, it becomes resistance. And I'm going to show you how to use these volume zones and how really, when the time is appropriate, to pull the trigger and take a trade. Now, I'm sure everybody has seen, I would hope, at a volume profile contour. And this can be for a day, it could be for a week, it could be a month. It can accumulate volume data on any given time frame. And it forms this histogram. And this is volume at price. For any given price, there accumulates a certain amount of volume in the time period that you're examining. Now here again is a volume profile, which I'm going to show you in a perfect world describes a perfect bell-shaped histogram, but in our world, which obviously is not perfect, it describes a histogram looking somewhat like this. Now, the random distribution of any set of data in a perfect world describes a bell-shaped curve. So if you take volume at price, and it was randomly distributed, it would form this shape. Now, the center of the bell is the mean price, or the price at which most volume has crossed on that trading instrument in a given day. When you have a perfect bell-shaped curve, the mean price, the median price, and the mode price are exactly the same. and 1 standard deviation's worth of volume describes the value area. And this area is price at which traders want to keep the financial instrument. Each market is an auction-style market where traders bid and ask on the price of the financial instrument, and they describe this area, and this is where they want the price of that financial instrument to stay. And here's just another representation of that perfect shape curve. Now the POC is the point of control, and that is the price in which most volume has accumulated. And the value area high and the value area low is that area where 66 2/3% of all volume at price has accumulated. And this is the fair value area. And this is where price wants to stay on the instrument that you're trading. Now here's our market profile. Here's the value area high, here's the value area low, and here's the point of control. Now I put in these blue lines to show you where the point of control was if the volume profile was a perfect bell-shaped curve. Obviously it's not, so it skews the point of control closer to the value area high. Now what forces come to bear on price? In this particular case it's crude, but it could be anything. It could be a stock, it could be a Forex pair, it could be any future. When price approaches the value area high, it gets pushed down. And when price approaches the value area low, it's going to get pushed to the upside. And the point of control is going to be a price attractor. This is the price that I don't have large histogram bars here. Some of the slides are going to have our market profile where the histogram bars are set to extended, and they're going to be much larger. But this is the largest histogram bar. This is the price that traders really want crude to trade at, which is $53.49. So point of control attracts price, and the value area high and the value area low repel price. The VAL to the upside and the VAH to the downside. And contained within the value area high and the value area low is 66 2/3% of all volume crossed on this financial instrument in the look-back period of this volume profile. So I just sort of repeated it, where we have the VAH repels price up, the VAH pushes price down, and the point of control attracts price. So this, right away, you're beginning to see how you've got areas of support and resistance that are very, very difficult for price to break. Now, the thing that's really important about market profile is that it must be dynamic, because this volume profile is constantly changing. Anytime a contract is crossed on a future, or a share is traded on a stock, or there's a change of 1 pip in a Forex market, volume profile is going to change. So the indicator system has to move dynamically intra-candle. It can't be the kind of market profile that only recalculates these areas at candle close. Because if you're trading a 3-minute candle, you can't wait 3 minutes to see where the value area high, value area low, and POC are. You have to know exactly where they are as the candle matures. And it's extremely important. Very few market profiles change intra-candle. Most of them will reformulate these areas at candle close. Now, in addition to the value area high, the value area low, and the point of control, there are also critical areas called low volume nodes. Now, low volume nodes are just the opposite of the point of control. The point of control is a big histogram bar. Lots of volume is crossed here. Traders want price on the E-mini here to be 2344.25. Now, almost no volume at price has crossed at the low volume node areas. They reject this price, 2346 and 2340.25. So they create additional areas of support and resistance on your chart. And they must be respected if your goal is to take a very low risk, potentially high reward trade. So what they do is they create zones of rejection. When the low volume node is confluent to the value area high, and this low volume node is close to the value area low, you get a rejection zone. And the software actually creates this opaque area and shows you this rejection zone. So if price is below it, you're not going to trade up into resistance. If price is above it, you're not going to trade down to support. This is a very, very difficult area for price to penetrate, and there's two different forces at work. This is a low volume node or a rejection price, and this value area high is a price that bounds fair value for the trading instrument. So therefore, price is rejected to the downside by two independent forces, and bounces and rejected to the upside by two independent forces. So they're very, very strong areas of support and resistance that are constantly changing as volume profile changes. Now, I've seen a lot of software that creates area, they call it the red areas, and these are areas of resistance. And these are blue areas, which are areas of support. And this is excuse me, this is not correct. These are areas of resistance as long as price is below them. When price breaks them, then they become areas of support. So there's no formal support zones and there's no formal resistance zones. There's just areas of rejection that price is going to have a lot of trouble moving through. And it's really best, again, if you want the precision of your trading to remain high, to avoid them. Now, this is a representation of volume profile within a given candle. And it shows you that there's a bid and an ask number. This is order flow tracking. And this shows you that there's a bid and ask representation on each candle, on the tick of each candle, or the cent of each candle, or the pip of each candle, depending upon what you're trading. And whether or not there are more traders on the bid or more traders on the ask creates this number above the candle called the market delta. And this market delta tells you whether there are more traders looking to buy or more traders looking to sell throughout this candle. Now, if it's positive, there are more traders looking to buy. If it's negative, there are more traders looking to sell. And you can see it isn't a precise calculation in the sense that it doesn't always predict the direction of the candle. You can have more traders looking to sell on an up candle and more traders looking to buy on a down candle. So, and this market delta is simply simply telling you whether the number up here is positive or the number is negative. When the market delta finally gets this really large red number, that market delta is going to push down below. But this has no predictive power. It's simply giving you this number in this visual representation. You don't know on the right edge whether the next number is going to be red or it's going to be green, and so it doesn't really tell you where price is going to move out into the future. Plus, it's very, very difficult to leverage the bid-ask disparity within any given tick value, although if you listen to some people, they'll tell you it can be, it can't be. So what we've done is we've changed it, and we've taken the numbers out, and what we've created is a candle that has a volume profile, and that the area that has the most volume is called the point of control of the candle, and to distinguish it from the point of control of the chart, it is known as the commitment of traders. And this commitment of traders is a very significant area in the volume profile in any given candle, and it creates a real powerful way for you as a trader of knowing whether you're taking a great entry, and in addition, if you're in a move, whether that move is likely to continue. So if you look at this trade right here, you have a move up, and then you have a pullback to support. And the support here is the value area low. And you can see that the commitment of traders is in the lower 1/3 of the candle on a long trade. That makes this an exceedingly low-risk, high-reward trade. You're sitting on dual support. This is a 15-period moving average. You're sitting on the point of control. The commitment of traders or point of control of the candle is in the lower 1/3. This light green represents to you visually that there's a great disparity in buyers as opposed to sellers. Rather than presenting you the numbers in raw form, what we've done is we create an intensity of green or an intensity of red to make it visually very easy to see and interpret. So you have to simply look at the color around the COT or commitment of traders on the candle, and this becomes a very, very low-risk, high-reward trade. Now this green here on the left, or the purple, is simply another way of visualizing the candle body. Because it's important to know, if you're trading price action, how much of the candle is wick and how much of the candle is body. And then you can see when you get a pullback fairly close to support here, the commitment of traders is at the bottom of the candle body, and you get a continuation trade to the upside. Here's another representation. Now you could take this will give you a very good idea of when to take a reversal or when to take a low risk reversal. In this candle, you're not going to take the reversal because the commitment of traders is in the middle of the candle. Now price falls, but since you're on the right edge on this particular candle, you don't know that it's going to. And the probability of price falling here is not that high. Here, you're right below the point of control. The commitment of traders is in the upper 1/3 of the candle, and it's sitting right below resistance. That's going to give you a nice short trade. Then price comes back up, and you get the same setup. And then you get this huge collapse. So the COT, or commitment of traders, of any given candle is simply a visual representation of the volume profile of that particular candle and provides you with a lot of predictive power in determining where price is going to move out into the future. And here's one more example. Here, the commitment of traders is in the middle of the candle. So you're not going to take or look for a move up off the value area low here. Here, the commitment of traders, or POC, is all the way at the bottom. And here's the trade you would take to get this long reversal trade to the upside. One more on the E-mini with the COT right at the bottom, right at support. to give you this move up. And here's a short trade. If this forms a double top, you could have gone short here with the COT at the top. If you waited to go short here, you have a double top here and a really low risk entry to the short side. Now, I did one more here. I labeled this as the point of control. This is actually the value area low, and another move up off support with the COT right at the bottom of the candle. Move through these. Now, we also leverage order flow, and order flow is extremely important. And for this webinar, we're adding this additional indicator. It complements market profile because it really is all about volume, although we add another independent variable, which is momentum. Now, the upper line here looks at momentum on the 2 higher time frames than your trading chart. So let's say you're trading a 3-minute. It's going to look at momentum on the 9-minute and the 27-minute. If you're trading a 5 range, it's going to look at the 2 higher fib numbers, an 8 range and a 13 range. Order flow does the same thing, and I'm going to tell you how order flow is calculated. Now, momentum is calculated. You can use an oscillator. You can use a MACD. They all give you momentum assessments, but what we use is a Heikin-Ashi formula. We peeled the Heikin-Ashi formula off of Heikin-Ashi bars, modified it, and used it to create this upper line. Now, order flow is the delta moving average of the 2 higher candles. So any individual delta value doesn't have much predictive power. But the delta value placed in a smooth 15-period moving average has huge predictive power. And we're letting order flow assess that delta moving average on 2 higher time frames. So this ignores momentum on your trading chart, and it ignores order flow on your trading chart. It doesn't look at the market delta of your trading chart or the market delta moving average. It looks at the market delta moving average of the 2 higher time frames, and this looks at momentum on the 2 higher time frames. So when they're red, the only direction that you can trade is short. If you try to take a long trade, the likelihood is extremely high that you're going to get stopped out. Now, here's an example. In this particular case, the delta, I just happened to shoot this when the delta was 0. But what we're looking at are these numbers placed at a moving average on the 2 higher time frames only, not your trading chart. So when order flow is green or blue, you're going to only trade long. When order flow is red or orange, you can only trade short. And in this particular case, you can only trade long. And what makes this an independent variable is it doesn't look at price on your trading chart. It ignores it. It's only assessing information that it's receiving from the 2 higher time frames than the one that you're trading. Now here's an example of where order flow and momentum are aligned to the upside. You're going to wait to break resistance here, and then the only direction that you can trade is long. If you try to counter trend trade, order flow and momentum, the likelihood is extremely high that you're going to get stopped out. It's another example. Now, you don't see the instrument and you don't see the time frame because they're irrelevant. It doesn't matter what you're trading. This could be a stock. It could be a futures contract. It could be a Forex pair. It doesn't matter. When order flow and momentum are aligned to the upside, you can only trade long because price on your trading chart is going to get carried to the upside. If you want to take a counter trend trade, you have to wait until order flow and momentum reverse direction. Now, all of these traders in these orange candles are counter trend trading the direction of order flow and momentum, and they're all getting stopped out. They're trading oscillator divergence, they're trading MACD divergence, maybe they're trading off of Fibonacci resistance. None of these things are going to predict how price moves out into the future, except an indicator assessing important independent forces out to higher time frames out. Here's another trade to the short side. What I wanted to use this slide to demonstrate is this. Why do we get chop on a market? Why is it sometimes that price just moves erratically and doesn't really trend? Well, one of the reasons is that these independent forces don't align. When momentum is aligned to the downside and order flow is aligned to the upside, price chops. So you have to wait for both of these indicators or both of these forces to align in the appropriate direction. Oops, excuse me here. Before you can take a trade. And you have to trade in the direction that that momentum and order flow are telling you, or you're going to get stopped out like all the counter trend traders here in these green candles. Another example, break of resistance and a move to the upside. And one more example of what happens to price when these forces don't align. Price chops. So starting now to put this together, here's a break of support. Only direction, we're only looking at order flow now. And all you can do is trade short. It doesn't matter, this is the E-mini. It doesn't matter if it was a stock or a Forex pair. The time frame is irrelevant. All you can do is look for a trade short to support. Then when you have a setup off a support, it's when order flow is long, and then you can take a trade to the upside. And then you look for a trade to the short side off resistance when order flow is red. When there is an overabundance of buyers on multiple candles on your two higher time frames to create a falling moving average on both of those higher time frames, you know that there's considerable selling pressure on this market. You don't want to go long. When it's green, you know that there's considerable buying pressure on this instrument, and you don't want to go short. What you do is you look for a long entry or you look for a short entry. And if you try to counter trend trade again, you're going to have real problems. And these are those support and resistance volume zones. You have to wait to break them to trade short or go long off the support that they create. And here's another example of a great trade in the direction of order flow up off of support. Now, I wanted to show you that sometimes, this is not the slide, but I'll show you what you're looking for here is you come down to support, order flow and moment. Order flow is aligned to the upside, so you look for a long trade and you get 7 ticks. Drop back to support, long trade gives you 9 ticks. Drop back to support and a long trade gives you 31 ticks. And then a move up to resistance with an order flow red gives you a short trade for 33 ticks. Now what your next assessment would be for a look of price you'd be watching for price to move up to resistance, and you take the short trade off resistance if order flow was aligned to the downside. Here, same thing. You're looking for a break here and a move to the upside. Japanese candlestick dogma tells you that you need a 2/3 candle body break to take a long trade. That's a riskier trade. The second arrow is a safer trade, and that's a 27 tick trade to the upside. This is a trade I took on crude, pull back to resistance and a move down in the direction of order flow. 18 ticks. Now here we're putting it together now. Here we have everything in one. Here's the multi-time frame assessment of momentum in the upper line. In the lower line, you see the multi-time frame assessment of order flow. It is order flow tracking, and it's telling you whether there's buying or selling pressure in this market. You can see that there's a significant amount of buying pressure here. A pullback to support. The commitment of traders is in the lower 1/3 of the candle, and you get yourself this great move up. Pull back to the point of control. COTs at the bottom. Both lines are green at the time the candle closed, and you get a nice move to the upside. This is how you leverage it to eliminate or mitigate risk and look for a real nice trade to the upside. Here's a trade to the downside. Order flow and momentum align. Your 50 and your 15 is down. Your commitment of traders is in the upper 1/3 of the candle. Here is the value area low, and you take a great trade to the short side. Another trade. Now this is the VWAP, the volume weighted average, the volume weighted average price. And you're going to see that on your chart as well. That acts as an area of support and resistance. But with both of these lines aligned to the downside, you see that momentum is aligned. And you see that on your 2 higher time frames, there's significant selling pressure. The commitment of traders is at the top of the candle. You're able to assess that this area of support is going to break. And you can see that it does break, and price moves right through to the downside. Now, there's the additional signal, and it's this orange block. And then when you see this orange block, it tells you that in the entire candle, there's a massive overload of sellers. And there's tremendous selling pressure in this candle. And when you get that, you are almost guaranteed, there's no guarantees, but you're almost guaranteed at least one continuation candle to the downside. So you get this signal right at the value area low, which is an area of support. And your ability to break this value area low now becomes very, very high because there's such intense selling and such an overabundance of sellers in this particular candle. And you can see you get a nice continuation trade to the downside and a break of support with this signal. Now here is a potential short trade. The commitment of traders is great. It's right below the point of control. But if you look down, you don't have momentum. You just have order flow. You want both lines, and price goes nowhere. There's another potential short trade or counter trend trade. Now, the commitment of traders, the COT, is in the middle of the candle. It is right at resistance. You don't have momentum. You just have order flow. Remember how important it is to have both of these independent variables aligned. Price goes nowhere. So you would step aside on this trade because you don't have the alignment that you need to take the trade. Here in real time, these were red. And here is where you take the short trade. Now the commitment of traders is not in the upper 1/3, but it's sitting right at the base of the candle body, which is why it's important to know where that candle body is. And if it's the base of the candle body or the upper 1/3, you've got yourself a nice short trade with the alignment of order flow and momentum as assessed on your 2 higher time frames. This doesn't give you a huge trade. This is a 13-tick candle. This is a 26-tick trade down to support. Now here's a perfect long trade. Now these are the kinds of trades that you wait for. Because when you get these are the kind of trades where I call them where you back the truck up to the bank, but risk on a trade like this is so low and the potential reward so high. If you as a day trader or swing trader simply have the patience to wait for these kinds of these trades to manifest themselves, and they do every single day on every market, you're going to get yourself nice winners. You're in at the close of this candle to the upside, and you see the next candle shoots that full body blue signal telling you that there's really a significant overabundance of buyers in this candle. And you're right, it's at resistance, which is the VWAP, the volume weighted average price. Are you going to break it? Very likely now, since you've got this signal which occurs intra-candle. Not at the close of the candle, but intra-candle. So price moves through it. The COT is at the bottom. Here the COT is sort of at the middle, and the COT does not break the value area high, and the trade peters out. So this is a very, very low risk, high reward entry. This is the kind of trading you have to use. This is the kind of system in order to garner these low risk trades. So I think I'm running a little fast. I don't know what time it is. I think it's only 1:40, and I'm going to have a lot of time for questions. But what we have shown you is market profile, volume profile, the value area high, the value area low, the point of control, low volume nodes, zones of rejection, the delta moving averages, which create the order flow line and tell you whether there's buying pressure or selling pressure on your financial instrument, the volume ladder, which is the candle that has those in each tick or pip or cent level. You can tell whether there's an overabundance of buyers. I finished at 1:45. Okay, and Heikin-Ashi momentum. So let me tell you what this is our 3.0 version. I'm sorry. Now this is for the first 10 orders only. In addition to the indicator system, you get 3 months in the live trading room with me, and you watch me trade it. And I traded on the E-mini, crude oil, and I traded on the 6E. And you come into our trading course. It's a 10-week series, and in the 12 weeks you're going to be in the live trading room. You're going to get the entire course. We have a lot of traders in the course. Some of them buy it independently of the room, and you will be coming in now on module 5. Then it would come around again, and you'd get 1, 2, 3, and 4. It really goes over all the nuts and bolts of trading, starting with trading price action, then price action and market structure, then price action, market structure, and indicator confirmation. And to get that 3-line indicator, the addition, that's the order flow tracking and the momentum tracking. So the whole thing together is much more expensive, and it's only $798. and it's really, really going to give you real excellent trades. You can overlay it on any system that you're currently trading now, and it's going to significantly improve your precision. The predictive value of getting a trading entry is going to rise significantly. Now here's our website, our email address, and our phone number, 786-713-5276. And let me just see if there are any questions. Okay, there are a few here. Hang on one second. Hold on. VB, I don't know which chart you're looking at, but really I wouldn't focus on the time frame, because the VBS is a 5-minute, 10-minute, or 15-minute chart. It's irrelevant. I like to trade range bars, but you can trade a 3-minute, a 5-minute. We have people trading 4-hour bars who are swing trading. It makes absolutely no difference the time frame. The analysis that you're looking at does not change. The indicator system is identical on any time frame. It doesn't matter. We use it on NinjaTrader or Sierra charts, Jim. Those are the two platforms that it works on. Ahmed, I was looking at mostly at the futures markets, but I had a lot of slides for stocks. I just didn't have the time to show them. It works terrific if you're day trading stocks. And and what I'm starting to do, actually, we just created the system. We're going to start day trading futures off of this system, and we're going to do it via an SMS text messaging service. So it really doesn't matter what you're trading. I mean, order flow is a universal principle. You want to know who's in control of the market, buyers or sellers, and it doesn't matter what the time frame is. And it does not matter what your financial instrument is, whether it's Forex, futures, or stocks. These principles hold just as firmly. I hope I answered your question, Ahmed, because I see a few. Thank you, James. I appreciate that, James. These indicators are available for NT8. That's correct. Pizzazz asks that, and they are 7 or 8. No, Jim, you're mixing the COT. The COT is a weekly financial report. That the COT is also known as the commitment of traders. It's just used differently in those two instances. I forgot what the COT report is, but there absolutely is a weekly financial report called the COT, Jim. This is a completely different assessment. They will work on interactive brokers. Interactive brokers, though, Sri, you need interactive brokers. The data feed will power NinjaTrader. So you'd have to download NinjaTrader, but your interactive brokers data feed will power the system, but just on a different platform. Sam, we use a 15-period moving average for a really specific reason, and it's a very complicated one. If you want us to, we can change it, but the 50, the 15, the 100, and the 200 period moving averages, I think, are very unique moving averages, and I give a whole hour seminar in the educational module to talk about. I mean, I don't want to run over, but if we, and I'm ready to throw up one for you. I just want to say this: if you don't specify specific moving averages, in theory, there's a 1 period, a 2 period, a 3 period. There's a moving average at every single period. So there has to be certain critical moving averages, and for me, they're the 15, 50, 100, and 200. And in that educational seminar, I explain why, and it's really based on physics. I do have a trading room. Yes, we do, VB. Just go ahead to the website. Yes, you can, Mike. Again, just go to the website. It's a 15 period, Rick. So, it's always looking back 15 periods or 15 candles to create that 15 period moving average for momentum and order flow. So that's how far back it looks. Now, it's looking at 2 higher time frames, so that 15 period is significant. If you're trading a 3-minute, it's going to look at the 9-minute and the 27-minute, and it's going to look back 27, and it's going to look back 15 candles on a 27-minute. NT8 is all ready. It is available, Pizzazz. We would look, Mike, we're trying to get it into Thinkorswim. We're not there yet, but we will be. It works on Sierra and it works on NinjaTrader, but if you have Interactive Brokers data feed will power NinjaTrader and allow you to use it on NinjaTrader. No, you don't, Jose. If you have Sierra or you have Ninja, you do not need any other software. There is volume provided, Stephen. If you look at the DOM on Forex, there's always a bid-ask, and there's always a bid-ask number. You can see the number of traders on the bid, the number of traders on the ask. In fact, that's what excuse me. That's what decides how big the pip spread is when you move into your trade. If there's only a small number of traders on the bid-ask or the DOM, the pip spread is going to be large. So you do get the number of traders looking to buy and the number of traders looking to sell, and that's the order flow tracking number that we look at. No, it works on futures, it works on Forex, and it works on any Forex pair. It is not only for futures, it works just as well for stocks. Yes, Mike, you can.